Yesterday was more dedicated to investing and, of course, the business owner fund. Today is the day for the emerging managers. This came about because when I started the fund and after a few years, increasingly I found that younger managers were reaching out to me and saying, hey, how did you get started? How did it all happen? And rather than speaking to each of them individually, I thought, well, wouldn't it make sense to try and get them all together in one place? Then I can tell them my story or speak to everyone as a group, but more importantly, they can also connect with other like-minded people, potential investors, their peers, and service providers are also here. So that was the original idea, and that's the agenda for today. So there's going to be 3 sessions. The first one is now with Matthias, who set up a fund. How long ago was it?
10 years.
10 years ago, yeah, of course, yeah. I recently read your 10-year memo. I'll introduce you shortly, Matthias. Then that's going to run until 9:45. There'll be no pause, but the coffee is there, so feel free to stand up and go and get yourself one if you need it. Then we're going to go straight into a fireside chat with Jacob McDonnell, who's the author of Capital Allocation book. He set up a little stand at the back there, and he'll be signing books afterwards if you want to. And then between 10:30 and 11, there'll be a longer pause for the signing, also for continued discussions. And then the grand finale will be a panel discussion between 11 and 12 o'clock. We've mixed things up a little bit this year. In the past, it was investors in emerging managers who we had on the panel. This year, it's going to be 3 investors who very recently started a fund, and I thought their experience would be relevant in terms of how they got started, how they solved the classic chicken and the egg problem of if no one knows you, how are you going to attract capital? But without capital, how are you going to build a track record and get yourself known? So that will be the final session. And before we know it, it will be 12 o'clock and it will be finished for another year. But I'll be hanging around afterwards. Several members of the group will potentially be skiing or going for a walk or whatever. So for those of you who aren't traveling back immediately, there's plenty to do this afternoon as well. So, Matthias.
Good morning.
Welcome. Matthias, you're one of my oldest investing friends. We've been talking about stocks for many years. I know you incredibly well. I think many of the group here know you well as well, but I'm sure some don't. So why don't you very briefly describe what you do and who you are?
Yes. So thanks first of all for organizing this. This is always great to come here and spend time here with a lot of really smart people in the audience. So I hope you can learn a lot from a few things that I might have done well, but a lot, maybe even more, from the mistakes that I've done. So I hope it's useful for you. So I run PNR Investment Management. We are advisor to the PNR Real Value Fund, which is very similar to you, a very concentrated fund. We started 10 years ago and have currently 12 positions, and we think pretty much aligned in terms of looking for great compounders, looking for great businesses and holding them for several years, hopefully many years.
Great, thank you. So let's go back to Matthias pre-PNR Value. What were you doing? What did you study? What were you doing before the fund started?
Yeah, so I started in Germany at a Sparkasse, at the savings bank, and I thought that's where you can learn how to invest well. And of course, it was a nice 2.5 years, but I didn't learn anything in terms of investing. Then I applied for a job in Düsseldorf back then at an options trading house, a Dutch options trading house. Learned.
So Buffett's famous weapons of financial mass destruction.
Of financial mass destruction. Well, I learned a lot there. I learned arbitrage. Sadly, when I came in, the window of opportunity where there was a lot of inefficiency at the Deutsche Terminbörse back in the 90s just moved away. And so all of a sudden...
This would have been late 90s or...?
That was like 96, I think. So right. Deutsche Terminbörse, I think, started in 92, and then there were a couple of years where nobody knew how to price options, and if you had a slight idea about black skulls, you could really do nice arbitrage. So at the end of the day, you didn't have any risk on your book, but you made quite hefty profits. And I came in exactly at the time when Timber Hill actually started to use computers to do it. And of course, we didn't know that. So we thought, what's going on in the market? There's so many quotes now. And then somebody started to look at charts, somebody else looked at fundamentals, and I was confused. I didn't know what to do, and I just knew one thing: I have no idea about the fundamental aspects of a company. And so after 2 years, I think faded out or was made redundant, or both, I guess. And then I did an undergraduate in Münster in Germany and in Portsmouth in the UK. And part of that 4 years was an internship, which brought me to London, to Canary Wharf, and I ended up taking up a job there at Citigroup in 2001. And that's where I spent 9 years of my career on the trading floor of, back then 2001 was the largest bank in the world. And so finally I thought, I have arrived. You know, that's where the guys are. That's where you can really learn how they do it.
The bigger the bank, the better they invest. Right?
and I think the big learning is that you know, if you want to learn how to invest, don't go to an investment bank. It's a mislabel. You know, you learn how to sell things and construct things and design things, but you don't really learn how to invest. But I think you know, always invert. So over the 9 years, I learned everything in investing that doesn't work. I guess that was quite helpful too.
So you went to Citibank, probably optimistic about the future, thinking you were in the right place, and I guess over time you realized this is not what I want to do. So what was the kind of the moment where that thought crystallized?
Yeah, it was as usual. It's these ideas that, you know, don't come in on one particular day. It's kind of a growing thing. But what I figured was, it's strange that, so at Citigroup I was responsible for designing investment products and selling them through intermediaries. So you might remember a lot of certificates back up until the Lehman collapse. They were quite famous, and there was a huge demand into all kinds of financial payoffs that were packaged within certificate in Germany, or structured products in English. And so I was one of the people involved in this product kitchen. And the strange thing was, if I was honest, I never wanted to invest my own money in my own products. And so I was the cook who didn't like his own cooking. And I thought, that's weird. And of course you kind of say, there are all kinds of compliance reasons why you can't invest, but actually you weren't really convinced, because you knew how the product came about. And so I started to read a lot of things. I started to read books about Warren Buffett, and then in the evening I thought, this does make sense. And then the next morning I went back to the trading firm and thought, like, this doesn't make sense. And it took a while for me to really then figure out what to do. I was, I think, early 30s. And in 2007, I think, I took an executive class at Columbia Business School in New York for 2 days with Bruce Greenwald. Hefty price, I think £5,000 or dollars for 2 days. And I went there was a classroom of maybe not just as big as this one, maybe 60 people or so. And after 2 days, I thought, damn, why didn't somebody tell me earlier that something like this exists? You know, that you can learn how to invest. And I felt like Neo, you know, in Matrix, where you take the blue, I don't know, the blue or the red pill, and I took the one where you wake up the next morning and like, damn, this exists, and I studied in the wrong place. And then I thought, okay, maybe I can still go back to school, but I was 30 years old. I was a bit old for a full-time MBA, but then I figured out there's this Global Executive MBA, which gives you access to Columbia Business School and all the value investing classes there, and also to London Business School. And so I managed to get into that program and sucked up all the knowledge that I could, you know, in terms of learning accounting and all the things that I didn't know as a specialized derivative guy.
Sorry, just a question of understanding. That was a program where you were a full-time MBA, or that was happening parallel to your work?
Yeah. So that is designed to work for people who are on the job, whereas I did the full focus approach. So I faded out of my job at Citigroup, and that was a lucky coincidence, because then I had, you know, really spare time and really could spend all my time on studying. Yeah.
Yeah. And I think we both, a good friend of both of ours who was a big influence of you from that period at Columbia Business School was Tom Triforce. Why don't you talk about his influence?
Yes. So his class is called Applied Value Investing, and you don't really know what to expect there. So there were maybe 40 people or so, 40 students. And I think after the first session, half of them thought, what the heck is this? And the other half thought, this is really interesting. And the reason was Tom never spoke about himself. So he always took himself out of the equation. He just gave us a good framework. And I think it was extremely helpful in terms of analyzing businesses in such a way that you figure out what makes a business great and whether the business you look at has these elements. And I think having such a framework in itself, I think, is a competitive advantage, because if you don't have a framework, you very often are lost. You don't know what to look for, right? We all have this idea about, oh, I want to find a business that has a great management. But then when you think about it, what does great management actually mean, right? And how does that translate into valuation? So how do you value great management? And so I think we dived into these specific aspects very nicely, and it's incredibly helpful.
Yeah, I remember you once telling me that half the class were disappointed because they weren't being told what to do, and the other half were ecstatic because they were learning to think for themselves on what to do.
I think that the reason also was Tom never talked about himself. And usually when you have a class at business school, somebody comes in and teaches you, he says, look, this is what I've done. You know, I built this business, and then we did this $1 billion exit, and you do the math, and then you know how much worth this person is. And then you're like, okay, he must know how it works, so therefore I need to do what he tells me. Right? And Tom said, well, look, if I did that, I can tell you all kinds of crap. And you pick that up because you think I'm successful. So I'm not telling you what I'm doing, where I come from, whether I'm successful or not. I want you to figure out for yourself whether it makes sense or not.
And Tom once said something to me about you. Matthias is someone who just can't help thinking for himself. So what a kind thing to say.
I thought that was like it sounded a little bit egoistic.
No,
I take it as a compliment.
Not of himself, for himself.
Right.
There's an important difference in
That's
that.
true.
Glad we clarified that. So you had this aha moment on part of the MBA program at Columbia Business School. The question, of course, which is the most pertinent one for today, is having thought, okay, this is what I want to do. There's a big difference between thinking that and then actually getting the chance to do that. So how did you get from A to B?
Yeah, so I started the program already with this dream in mind to hopefully afterwards set up my own thing. I didn't quite know how to do that. I was just very determined. I think that the driving factor was the fear that, you know, one day in my life I look back and I have to admit that I didn't even try it. And so I think for everybody here who's contemplating doing something entrepreneurial, whether starting a fund or starting a business, I can only encourage you to do it earlier than later. Even if you fail, I would say you have so much more knowledge and so much more learning that you can then use to do whatever you want to do afterwards. And in many cases, people actually manage to go back to their previous job at a higher hierarchy. In banking, I've seen that several times. So I think back then that was my driving force, really to get this done. And even if you fail, at least you can look in the mirror and say, I've tried it. And so after the MBA, back then I had a partner, an economist on the macro side, because that was 2011, 12. And back then, I don't know if you remember, there was the financial crisis in 2008 and 9, but then there was the Euro crisis. And so that taken together left a lot of people being really concerned about the future outlook. And we looked into the macro side, we're concerned about central banks, and I thought it's a brilliant idea to combine the bottoms-up, stock picking, value investing, with macro top-down. And so on that basis, we started to talk to potential investors, used our existing network, lots of meetings, phone calls, a lot of feedback that sounds really interesting. We'll come back to you, and then you never hear back. So that's normal if it happens to you. But luckily, we had built some really good reputations with investors and with individuals within institutions. And we got two starting tickets from 2 insurance companies in Germany. And they are still invested with us now after 10 years. So sometimes you find really good investors and really good, nice people. And I'm very grateful for that within environments where you don't expect it. And so that was the starting ticket. We started with 12 million in end of 2011. Yeah.
Well, fantastic. And talk about how your investment philosophy evolved over that period. It sounds like there was a strong macro component at the beginning. How did that evolve?
Yeah. So my partner back then was Thorsten Polleit, and Thorsten is very good in analyzing central bank policies. And we were quite bearish overall because we thought all this money printing, that can't go well. At some point, people will probably wake up to the fact that the currency they keep in their wallets is really weak. And what implication might that have on investing? How do you invest well in that environment? And that was 10 years ago, right? So back then, if you'd told me that in 10 years, we are where we are right now, I would have thought, no, that's unlikely. I think some sort of currency reform or something might have happened in the meantime. And so the difficulty we figured out is how do you translate that into actual investment decisions? And we figured out it's really very, very hard. And on the individual stock picking side, on the analysis of companies, I try to focus on businesses that have all the ingredients to cope or are better suited to cope well with inflation. But otherwise, in terms of timing and so on, it's really, really hard. And to this day, I've not met somebody who can really plausibly explain to me a methodology how to do that. And so over time, over the first years, we basically faded out of the macro thinking more and more and became a pure investor in great businesses. And then Thorsten also learned that too, and he faded out then after a few years.
Yeah. So describe how you invest. What is the key things that you look for in a good investment opportunity?
Yeah. I think whatever you do in investing, there's just basically one important thing, which is the relationship between price and value. And you can apply that principle in all kinds of ways. You can apply it in bad companies, in mediocre companies, or in excellent companies. You can apply that in any asset class that you can independently value. And so I think that's the number one thing, the relationship between price and value. And it's, by the way, it's so easy that somehow price makes its sneaky way back into your own intrinsic valuation, right? So it's really, really a simple concept, but I'm always amazed how fuzzy thinking is between price and value, right? If you read an article in some newspaper in Financial Times, it's always a mixture of fundamentals and then the stock price. If you speak to board members, their idea of valuation is what the city, I'm based in London, so the city meaning the stock market, the analysts, etc., think about the stock. So they do not have a clear framework in their mind, which means there is a distinction between what the price is, the current price today, and the independent valuation of that business you look at. That's the most important thing.
So describe how you arrive at the value of a company.
Yeah. So just to finish your question, so on the spectrum on value investing, I'm on the quality side, as you are as well. So I prefer to look into great business. I'm excited to learn business stories, right? I'm excited to study businesses that have produced tremendous shareholder value creation over time. And I look for these patterns, and I look for businesses where I see these patterns. And then we try to, look in areas where there's not so much competition, and hopefully find these we call them young elephants a little bit earlier than when they are really ripe and visible to everybody. So that we try.
Let me sneak in another question, because that's such an interesting thought about there being this sort of spectrum between sort of mediocre to great companies. I guess a counter argument to that might be, on balance, most people prefer great companies to not great companies. So why wouldn't the better opportunities be in the worst companies?
It could be. It could be. I'm not ruling that out. It's just, I think you have to ask yourself, what do you like to spend time on, right? When you wake up in the morning, do you like to sift through all these kind of crappy companies and want to figure out who are the, 20 or 30 that I want to invest in on a on that basis and then hope that statistically the overall performance is pretty good? Or do you want to spend your time on great businesses? Or do you want to spend your time on special situations or some situations where you have to study legal documents, right? It's really down to your own kind of personality and passion, what you should be doing, I think.
Okay, then back to valuation. How do you think about it?
Yeah, so the math is pretty simple. It's the present value of all future cash flows from here to eternity that you can take out of a business. So that's the math. I think it's always helpful to look at a business and to start with a lot of questions about the quality in that area, what we are doing. And there are a lot of elements that flow into this valuation. So you can think of how attractive is the product, how big is the market, how good is management, and we can dive into what that actually means. But everything in the end flows into the final valuation. And that's where I would call basically the end product, the financial engine of a business. And if you think about it, what we are trying to find is we try to find compounders. And so you can really sum up the elements that you look for into how much is the earnings potential of a business you look at. So you can call that the free cash flow currently or on a normalized basis. And how much of that ends up in your pockets through dividends, and how much of that is reinvested, at what rates of incremental return, and for how long is that period of growth. And then you have to discount those back with an appropriate discount factor to today. And so it really comes down to those five inputs that you have to be good at estimating.
So to dive a little bit deeper in that, why don't you pick 2 companies in your portfolio which illustrate how those inputs can differ?
Yes. So the ideal company is, of course, one where all of the earnings can be reinvested at very high incremental returns. And then you create this beautiful compounding exponential function, right? That's what we want. And the exponential function, by the way, is very hard for us to grasp. And that's why you sometimes get opportunities where this exponential function works longer than you think. And therefore, the multiple actually should be higher than what you think. And so one example of that could be Moody's. So Moody's is a company which is not a young elephant. It's quite established. And I think if you know Moody's a little bit, you know that they have this incredibly strong ratings business. And I think it's probably one of the strongest modes.
It's the company that gives the bonds the AAA ratings or,
right.
or whatever.
Yeah. So if you were working in a treasury department and you have to issue bonds, there's no way you can't pass by Moody's. And usually you go for Moody's and S&P, right? They're not even in competition because most of the time you need both ratings. And so the difference between having a rating and not having a rating is, I think the latest study I read is around 65 basis points on an annualized basis. So it's tremendous if you think about the probably 70 trillion or so of debt that's out there that's being rated, right? So the value creation through that stamp of approval is incredible. And so you think that, okay, they have a strong moat, right? So what does it mean for this financial engine? Well, they have incredibly nice margins on that ratings business, but the problem is they can't really reinvest the free cash flow into that same business at incredibly high returns on incremental capital. So what they've done over the past is they reinvested it, A, a little bit into dividends, B, a little bit into buybacks, and then thirdly, they did acquisitions in all kinds of analytical and research kind of software companies. And that's called Moody's Analytics, so that's the second part of that business. And so if you look at that business or these 2 businesses, normally you would say like, oh, okay, they might have really, really high returns on capital, and they do. However, what's really important for you is the return on incremental capital. And so when they bought these analytics businesses, they bought them at market prices, i.e. at quite high multiples. And so when you work out the return that they actually achieve from these investments, it's probably only at around cost of capital, right? Which is probably, I'd say, around 10% or maybe slightly less even. Right?
So it's not a very mediocre business in terms of
exactly
the reinvestment.
Exactly.
Yeah. So what would be a counter example to that?
Yes. So, which basically comes back to putting a valuation on a business with a great management team that understands capital allocation and a business team or a management team that is not so great. I'm not saying Moody's management team is bad, it's just what you see. And so another example would be a very small company that we own for quite some time, which is based in London. It's called Judges Scientific. It's a company that invests into small niche businesses that produce and manufacture scientific instruments. And David Ciccarelli, who founded the company and who runs this, is a fantastic capital allocator. So what he does is he buys these small companies at typically around, historically, between 4 and 6 times EBIT. Now let's say average is 5 times. So if you translate that into return on incremental capital, you know, he debt finances it probably at around 2 turns. So he pays 5 times, 2 times from debt, so 3 times equity. Then you have to subtract a little bit of interest, you have to subtract tax, and if you work that out, you get to probably around 23% return on equity. And so if you keep on doing that, if you reinvest 100% of your earnings, your growth rate will be 23%. But it depends on you finding these acquisition targets. And so over time, he has produced incredible shareholder value through doing that. But of course, with bigger size, it becomes more and more difficult to find these nice, niche, cheap companies. And but the outcome that you see is a phenomenal track record. I think David has issued the shares at 95p 18 years ago, and the stock trades at, I think, on Friday at 88 pounds. In addition, even pays dividends, so that's a 30% CAGR over 18 years. And that's a phenomenal compounding outcome, right? So that's another example of a great financial engine.
Yeah, I love your financial engine model, and you also you have a very simple spreadsheet where you calculate it based off of a theoretical $1. Why don't you describe that?
Yeah, so maybe that's because yesterday you spoke about great business and great management. I think we often struggle, and I guess many of you too struggle to how do you translate that into a valuation. And so if you think about a business that, let's say that makes $1 in earnings, and it reinvests this $1 in earnings at a 10% return, and it does it for 10 years. And let's say you discount it at 10%, then the result is 10. So in other words, because you start with $1, it's a PE ratio of 10 times. It's a fair value of it. So let's say you have the same business run by a very competent and skillful capital allocator, and that management team manages not 10% return, but it manages, let's say, 15% return. Right? If you do the same thing, you have 15% growth because 100% reinvestment rate, and you discount it, you get to something like 14.9. Let's call it 15. So that's a 50% difference in valuation. Now think about that.
5x.
No, 50. So
okay.
The first one is 10, the other one 15.
Got it.
Right? So in other words, if you look at a company with a mediocre management team, it's worth 10 times. The other one, in that example, 15 times. So 50% more. Right? So you can actually put a value on your assessment of the management team. And I think it's really useful to always try to do that. Always think about valuing things. Always try to think about what's it worth.
Yeah. Aside from investing, you also are yourself an educator now, maybe inspired by Tom. Describe what you're doing in terms of the students in London.
Yeah. So when I studied back in 2010 to 2012, I always thought, gosh, I wish I could speak to somebody who started a fund and who's on this journey, and I can ask all these stupid questions. But there wasn't somebody like that there. So when I managed to start it a few years in, I thought, why don't I just offer it? And I sent an email to the Investment Management Club at London Business School and just offered a mentorship. And that worked quite well. And so since then, I've been mentoring a small group of people, probably usually only 5 to 7 people. Some of them are here. And that's a lot of fun because you can, when you teach things, you can really instantly know whether you have understood it or not. So there's instant gratification also in passing on things. And then beyond that, there are lots of other things that come back to you. For example, I found a very, very good analyst, Akash, who's now with me since 2019-20. And many other really interesting opportunities come up from working with great people. And so I've been doing this now for the 13th time. And yeah, I can recommend, passing on knowledge to other people a lot. It's intrinsically, it intrinsically makes you happy.
What a wonderful thought. And one of the things we talked about in the context of our discussion today is, young aspiring managers, they shouldn't try to be like you or like me or anyone else. They should try and be something which is sort of a true expression of their own personality. And of course, everyone's personality is unique. So what would your advice be to them to sort of get to where you are today, but not by being you, but being themselves?
Yeah, I think that's very hard, right? I think not many people, even in their 40s or 50s sometimes, know what they actually really want to do. I can think of a helpful framework. I think it's in Jim Collins' book, Good to Great, in the chapter Hedgehog Principle, I think it is. So there are 3 circles. And the first circle is, what is it that you love to do? So when you wake up in the morning and let's say you have spare time, what do you tend to do? What is really the stuff that you're excited about? That's the first thing. And write down all the things that come up there in that field. The second one is, where do you think you can reasonably be really, really good at, potentially the best in the world at? Right, so if I say I'm very good, or I love to run a marathon, but I would probably never win against Kipchoge or something.
I think that ship has sailed.
Yeah. So you get the idea. And then the third one, the third circle is, how can you build an economic engine around those things that are in the intersection of those 3 circles? And I think that's a very good framework for you to really write down all the things that you can come up with, and then find this thing in the middle. And otherwise, I think it's just really in life about iterating for as long as you need to find your niche. And probably you need to go through a number of iterations to do it, and just be open about it.
Yeah, it's wonderful advice. The advice you more typically hear is sort of follow your passion, but it's not very helpful advice. A lot of people at 18 aren't quite sure what their passion is, and to the extent they have a passion, it might not be something which is immediately monetizable. And I like your framework a lot better. It's a wonderful note to maybe let the remainder of the group here maybe ask 1 or 2 questions. We've got about 10 minutes left. Do we have a microphone? Olivia, do you want to? Who'd like to ask Matthias a question? Claudine at the front.
Oh. So, Matthias, I have one here.
Hi, Nate.
I like how you started with the concept of having the right framework as a sort of trail map to get you through the wilderness. In the last 3 to 4 years, have you evolved your thinking from first principles on anything around your central frameworks? It seems like there was a period where you de-emphasized the macro thinking, but as you've continued to hone in on your frameworks, what's changed recently for you, if anything?
I think nothing really has changed fundamentally in terms of that framework. What has changed is your understanding of the individual elements. And I think that's a lifetime journey to get better and better. So for example, when you think about assessing management, so one of the questions of the framework might be, what's all the evidence for or against that management, the board, and other shareholders are aligned with your priorities as a long-term shareholder? Now, when you start out, how much do you know about the board? I mean, you can read their CVs, but what does it really tell you? Right? So how do you get up to them? And I always say to my mentees, you should look at the the list of AGMs in London and just pick a few interesting companies, just go there. Because usually there's nobody there. There's just some helpers, some financial advisors, and some lawyers, but usually no shareholder, or maybe just a few. And so it's very easy there to go up to the board, just introduce yourself, ask some smart questions, have a coffee with them, and you get to know them. And so over time, I think I developed a much better understanding of how to answer that question, right? How to assess the board, for example, and engage with the board in some instances where you need to, and sometimes where you're not so quite sure whether there is alignment or not, right? And what can you do to change that, potentially? Yeah. So that's an example. You get better at the individual elements of the framework, but the elements themselves don't really change. They shouldn't. Yeah.
Claudine had a question at the front here. Yeah. Let me give you my microphone. It's closer.
Thanks, Matthias. But I was just wondering about kind of input-output, because my feeling is that a quality company is one that has produced quality results. So how do you look at it, like your judge is scientific before they've actually produced the results? What is it, the core that you're looking, that company has a potential to produce the results before they produce them?
Yeah, so that's the great detective work, right? So you have these questions that I like to find answers to, and I just gave you one example. And essentially what I do with the help of Akash and sometimes other students that I put on projects with, so here's one, by the way, Luca, who I've worked with. So I try to find answers to all these questions, and I basically collect all kinds of little puzzles, and I turn them around, and at first you don't really see a clear picture. But the more you do, the more you turn around, then eventually, hopefully, you see a picture. And if you find a company that scores very high in all those elements, then the likelihood is high that this company will produce growing cash flows over time. And then you can put a value on that, and then it's always down to comparing that value, that intrinsic value that's independent from the stock market with the current stock price. And if there's a sufficiently large margin of safety, then you're onto something. And by the way, a lot of these elements, you need to really often go out, right? So leave the desk, go out, speak to people, go to conferences, test the product. I'm amazed how many investors never actually test the product. I mean, if you can test the product, right? If it's a B2B business, that's a different thing. But if you can test the product, immerse yourself in the business, use the product, speak to people who use it, speak to a lot of customers. And so try to figure out much more than just by reading an analyst report. It's just another opinion.
There's a question at the front here.
Hello.
Jonas.
Can you please tell us about your worst investment and what we can learn from it?
So
Your worst investment and what we can learn from it.
I'm thinking because there are several opportunities to dive very deep into several of those mistakes, and I'm not quite sure which one was the biggest one. So one is Carvana as well, and I guess that's something that Rob probably also covered in his letter. So I give you another one, which is Naked Wines. And maybe some of you might know the company. It's a company that has a subscription model for wine, and there's an interesting flywheel coming out of that business model, which means that you pay upfront for wine that you might get in the next season, and this upfront payment allows the company to fund winemakers to produce the wine. So they like it, the customers like it, because you get the wine cheaper than otherwise, and you get access to really some artisan, interesting wines. And hopefully the shareholder should also benefit from it, because the model should be profitable. And so over the last, 2 years or so, they had an incredible uprun in the COVID phase, because a lot of people were sitting at home and they ordered wine online. But as similar to Carvana, they overextended the investments into growth, thinking that will go on forever. And so it didn't turn out that way. And so now they have a very high cost structure, and the investments into growth, into customer acquisitions, didn't return the paybacks that they expected. And so that's an example where, when the tide goes out, you see who's been swimming naked, and, the name of the company should have given me a clue, Naked Wines. So that's one example. I think they have, however, a pretty good chance to get back. And unlike Cavrana, I think debt is not an issue there. It's just really about being very cost conscious and balancing this growth with profitability. And by the way, in terms of capital allocation, that's a very good question in that context, because when you talk to the board or the management, it's a really difficult question whether you grow yourself out of the high cost structure, or whether you pivot back to profitability and let go of growth. I think a lot of companies are at that point right now where they have to make this difficult decision. And a great capital allocation framework within the whole company is extremely useful there.
Who's next? Kevin?
Hi. What's the most important thing on which, in terms of investment approach, where you changed your mind over the last 3 years?
I think it's coming back to capital allocation, and I've done a few investments where I thought capital allocation not so important because the company is on a nice growth trajectory and they don't need to understand it that well for as long as they understand how the investments in growth have a high return. And we've often then learned that once they don't grow that much anymore, the actual capital allocation question comes up very quickly. And then the cash doesn't end up in our pockets, but somewhere else, often in some overpriced acquisitions and so on. And so I think it's really that question, how important alignment really is and clarity about what this company wants to achieve. And it sounds very simple, but the fact is, if you speak to a lot of people within the business, so for example, when you analyze a business and you meet with the manager, maybe with some other people in a lower hierarchy, maybe people on the ground, maybe the board, ask them, what's the one thing you think you can be the best in the world at? If you get totally different answers, it tells you there's no clarity in the company. If you get similar answers, maybe different words, but basically the same kind of thing that they tell you, you're onto something.
I think we have time for one last question. I see a hand at the back there.
Yeah, you just previously mentioned the margin of safety, and I was wondering how you go about applying the concept of margin of safety. Do you use it more as a discount from the price you're willing to pay, or do you think of it in terms of business quality and business quality embedded margin of safety?
As I said before, you need to translate business quality in some quantifiable number, because only then can you really compare different opportunities. So the trick is really to translate these qualitative elements into a number. You can, and I think you should use different vantage points in terms of valuation. There's no just one way to do it. One way, as I said, is looking at the financial engine and then understand what kind of multiple would be fair for it. And the other way would be just to look at the current earnings power, just to say, okay, if this company I'm looking at were to, stop growing, let's say, and just reinvest enough so that it retains the competitive position, how much earnings, how much cash could I take out of that business right now? And if that amount, relative to the price you pay, gives you a kind of yield of, let's say, 10, 12% already, then you're onto something. Right, so there are different vantage points that I would use. Another one is you could say, how much runway does this company still have in abnormal growth potential? I brought up the example of Moody's. So Moody's has a very strong moat. And you could say, okay, am I comfortable to go out 5 years and assume that over the next 5 years, the moat is so strong that they keep on extending that period of abnormal earnings growth? Then you might be able to say, well, maybe I'm comfortable even to go out further than that. And then you have an interesting thing, which I think applies to Moody's. Most analysts, if you look at their valuation model, only have 5 years for discrete growth numbers. And then it kind of assumes that the abnormal growth rate goes down to some kind of average. So they type in their terminal growth rate there. So if you find a company like Moody's where you might get the confidence in their mode, i.e. meaning you think they will be able to go further and grow further than these 5 years, you can find interesting situations like Moody's that they, over the many years I've been holding them, constantly trade somewhat too cheap. Even though the multiple is already at, I think currently is probably this year's multiple is around 30 or so, optically it looks expensive. But if you really dive deep into it, you see that it's potentially not overpriced.
Wonderful. Matthias, I really enjoyed this. Thank you so much for coming for many years now, and it was a wonderful discussion. Thank you very much.
Thank you.